Welcome to Financial Math Derivatives Part 2. This is a follow-on to the earlier lesson where I covered now some additional topics. We're going to talk about forwards and futures, swaps, structured credit products, and a little bit about the financial crisis of 2008. On the next few slides, I want to talk about something called forwards and futures. And I've summarized the differences in a table that spans this slide and the next. So a forward is a private agreement between two parties to buy or sell an asset at a specified future date for a price agreed upon today. So futures are similar, except, and you see I have it highlighted here, they're a standard contract traded on an exchange to buy or sell an asset at a specified future date for a price agreed upon today. Now there's some other variations, but these are the two big differences. So these are private agreements between two parties, and this is sort of controlled by an exchange. The basic purpose, used to lock in a future price and reduce uncertainty, used to lock in a future price, hedge risk, or speculate on price changes. Trading location, over the counter or negotiated privately. And then the futures are traded on organized exchanges. So in terms of standardization, these are customized. They're kind of in a contract between two parties, so they make up what it is that they need. However, the futures are standardized in terms of contract size, expiration dates, and settlement procedures. Flexibility, of course, if it's an agreement between two parties, they can pretty much do what they want and then sign off, with some legal supervision. In the case of the futures, they're a little bit less flexible because the terms are set by the exchange, so there might be fewer options there. The counterparty risk, that means someone reneging on the agreement, is higher here between the two parties. In the case of futures, the clearinghouse, the exchange, guarantees the result, so there's less risk here. And then there's a margin requirement in one case. For forwards, there's usually no daily margin requirement, although collateral may be required in some contracts. And in the case of futures, requires margin deposits, and they're adjusted daily. So depending on how the particular entity you're betting on in the future changes, for example, if the price of the stock goes up or down, you might have to change the amount of margin that's required. Okay, so let's continue. There's more items to compare. I'll have that on the next slide. Marking to market, usually settled at the end of the contract. Mark to market daily, with gains and losses settled each trading day. Liquidity, these are, because they're very specific to two parties involved, there might be hard to sell. And on the other hand, the futures are the standardized contracts, so they might, and more likely they're easier to sell. Closing out the contract early, often difficult to exit unless both parties agree or an offsetting contract is arranged. And in the case of the futures, since this is like an open market, it's easier to close out by entering an opposite futures position. Common users, some similarities between the two. Businesses, banks, institutions needing customized hedges, hedgers, investors, speculators, and financial institutions. Main advantages for the forward is the customization, and the futures advantages are the liquidity, lower counterparty risk because of the exchange basically ensuring each party gets what they've agreed to, and easier trading. Then main disadvantages: higher counterparty risk and lower liquidity. So you can kind of see the advantages here or the disadvantages here. And then less customization and daily margin requirements. And then the key similarity, I just put this in one box here because it applies to both. Both are derivative contracts that obligate the parties to transact in the future at a price agreed upon today. Okay, so that's sort of a high level of the two things, and I'm going to do a little bit more in terms of the details of forward on the next few slides. I have an example of a future on this slide here. Suppose someone buys a futures contract at $50 per unit, and the contract is for 100 units. So your agreed futures price is 50 per unit. Now suppose the future settlement price changes as follows. So you started with this agreement, but then, it may be several days out or weeks or whatever, months out. So it changes. On the first day, the actual price, let's say it's a stock, it goes to 52. So there's a gain of $2 per share, or a total of $200. Then it drops $3. So there's a loss of $300. Then maybe it goes up again on day 3, $2. So there's a gain of 200. Your original contract price was for 50, but the market value of your position changed each day. So your margin account is adjusted each day. The margin account is not a down payment on the asset. It's a security deposit or performance bond. It exists to make sure each party can cover daily losses or gains. If your futures position loses value, money is taken out of your margin account. If the balance falls below a required level, you can get a margin call, meaning you must add more money to your margin account. So the margin changes because the contract price is fixed, but the value of your position changes as the market future prices move. So for example, you agreed at 50, but if it goes up to 60, then and let's say that's at the time where the term of the agreement is, then you're only paying $50 for something that's worth 60. So it's you're getting a bargain there, and so in that case, the buyer gains money, and the margin balance goes up. And on the other hand, if the price falls, the buyer loses money and the margin balance goes down. And as I mentioned up here, if the margin balance falls below some agreed upon level, then you may be asked as the buyer to add more money to your margin account related to this contract. Let's turn our attention to forward pricing. What is the fair forward price F? The answer follows directly from the no arbitrage principle, which I'll discuss in a minute down here, and the compound interest formula. We could also use continuous interest, but I use compound interest for our discussion here. So no arbitrage means the prices in a financial market are internally consistent so that no investor can construct a risk-free trading strategy that requires no net investment and guarantees a positive profit. In practice, this principle is used to determine fair prices. If two investments have the same future cash flows and the same risk, then they should have the same present value. Otherwise, an arbitrage opportunity would exist. So we're going to use that idea to arrive at this price F. Suppose the underlying asset currently trades at price S and pays no income, so no dividends, no coupons. An investor who wants to own the asset at time t has two equivalent strategies. Either enter a forward contract today and receive the asset at time t at some price f, which we need to determine, or buy the asset today for s and hold it until time t. So let's analyze this in the next slide. Let's finish the analysis here. We want to find the value f, or the price f, for the forward. And I copied the two strategies here at the top so we can refer back to them. To derive the formula for f, suppose the investor buys the asset today by borrowing S dollars, or whatever your currency is, at the risk-free rate R. At time t, the investor owns the asset but must repay the loan. Since the loan grows at S times 1 plus R to the n, this is just compound interest. N is the number of periods between now and time t. The cost of obtaining the asset this way is S times 1 plus R to the n. A forward contract provides another way of obtaining the same asset at time t. So this is strategy 1 now, that you pay F and receive the asset at time t. Since both strategies deliver the same asset at time t, no arbitrage requires the two costs to be the same. So we want F to equal S times 1 plus R to the n. In the previous slide, I said that the asset didn't have any, or we assumed the asset didn't have any dividends or other income, but we can actually handle that case too. If the asset pays dividends or other income, was present value I over the life of the contract, the forward price adjusts to F equals S minus I times 1 plus R to the n. So it's just a slight change to the original formula. And that's because owning the asset earns income worth I in present value terms. The effective cost of carrying the asset to expiration is S minus I rather than S. So that's why we have the variation. And on the next slide, I'll do an example, and it'll actually be for this case here where you do have some income accruing to the underlying asset. I have an example here. It's actually quite a nasty example. There's a lot of little nuances that are easy to miss. A share of stock, let me point here, a share of stock currently trades at $80. It will pay a semi-annual dividend equal to 2% of its current price, $1.60 per payment over the next 3.5 years, with the first dividend paid in 6 months. The risk-free rate is 4% effective annually. A forward contract expires in 3.5 years. What is the fair forward price? So we want to use the second of the two formulas because for the fair forward price, this one here, because we have these dividend payments. So we know S, it's the $80, and we know R, it's 0.04, and we know N, it's N sub 2 is 3.5. The reason I'm using an N sub 2 here is we have a different N as part of our calculation, so I gave them different names. What we don't know is I, and that's related to these dividend payments. So once we can compute I, then we can just plug that in and get our fair forward price. So we calculate I. We first want to convert this risk-free rate into an effective rate per semi-annual. So it's 1 plus I squared. In other words, what rate is it when you compound it twice? You get the 4% or 1.04. Then we just solve for I. We take the square root on both sides, subtract 1, and I is 1.98%. And then we want to know, given that rate, how much money do you need to start out with at the beginning of this agreement in order to pay the $1.60 7 times over the 7 semi-annual periods. So that's basically an annuity. I copied the formula down here from, this was quite a few lessons back, but just to remind you, I've copied it here. So R is the $1.60. I is what we just computed. We have to make that a decimal. And then N sub 1, which is different from N sub 2, that's 7. And then you just do the calculation. You get $10.37. Plug that into our formula, and we get the fair forward price is $79.90. It might seem counterintuitive that the forward price of $79.90 is almost identical to the current price of $80 after 3.5 years have passed. This illustrates the fundamental balance in forward pricing. We have two forces working here. The risk-free interest rate pushes the forward price upward, reflecting the time value of money and the cost of tying up capital, in this case 3.5 years. Conversely, the asset's dividends pull down the forward price because the forward buyer misses out on those cash flows while waiting for expiration. That's the dividends that we talked about. Because the annualized dividend yield in this example roughly matches the 4% interest rate, those two opposing forces almost perfectly offset each other. If you want to try another exercise, instead of $1.60, try $7 for the dividend, and you'll see that these two numbers are no longer that close together because you don't have the balancing, which was sort of almost a coincidence in the way the numbers were picked. Yeah, and the other point I want to make here is just the variable R, the risk-free rate. I just thought I maybe mention a little bit more about that here. The risk-free rate used in forward pricing is the market interest rate for a default-free investment with the same currency and term as the forward contract. So it might be the rate of some type of treasury bond, in this case 3.5 years out, but it's not arbitrary. It does roughly match the same time frame as the forward. It represents the financial cost of buying the asset today and carrying it until the contract expires. On this slide, I have a different type of option. It's called a swap. A swap is an agreement between two parties to exchange a series of cash flows over time. The most common type is the interest rate swap, in which one party pays a fixed interest rate and the other party pays a floating interest rate, typically tied to a benchmark such as SOFR, the Secured Overnight Financing Rate, which replaced LIBOR in most markets. Both apply to the same notional principal N. The notional principal itself is never exchanged. It is simply the basis on which interest amounts are calculated. So in the plain version, fixed for floating, which is what we described up here, interest rate swap. At each payment date, the net cash flow from the fixed rate payer to the floating rate payer is given by this formula here. So you have the fixed rate minus the floating rate, and of course these can change in each payment date, and that's times this notional principal. So that kind of gives you how much money is being transferred between the two parties, where R sub fix is the fixed rate, R sub float is the floating rate for that period, both expressed as rates per payment period. If the net payment is negative, so in other words, if the float is bigger than the fixed rate payer receives money from the floating rate payer. And of course, if it's the other way around, if this is positive, then the floating rate payer receives money from the fixed rate player. So we have a comment here concerning the fixed rate. The fixed rate is set at inception so that the present value of the fixed rate payments equals the present value of the market implied floating rate payments. At this rate, called the par swap rate, the initial value of the swap is zero to both parties. As interest rates change over the life of the swap, the market value of the position changes, creating gains for one party and losses for the other. We'll see this in an example. Computing the market value at any point requires discounting the remaining cash flows exactly as in the bond and annuity calculations, which we saw in earlier lessons. Why use a swap? We have a couple of examples. They're kind of the opposite of each other. A company with a floating rate loan may want to avoid uncertainty in its future interest payments. It can do this by entering an interest rate swap in which it pays a fixed rate and receives a floating rate. So this received floating rate balances off the floating rate loan. The floating rate receipts from the swap offset the floating rate payments on the loan, leaving the company with an effectively fixed borrowing cost. Then you can go in the other direction. A company with a fixed rate obligation that wants exposure to falling interest rates can enter the opposite swap. It receives fixed and pays floating, thereby converting the obligation into a floating rate exposure. Economically, a swap reallocates interest rate risk. The party that pays fixed and receives floating benefits if floating rates rise above the fixed rate because the floating rate receipts increase. The party that receives fixed and pays floating benefits if floating rates fall or remain below the fixed rate because it receives steady fixed payments while making smaller floating payments. So here we have an example that I've been promising. A company enters a 2-year swap with annual payments, paying fixed at 5% and receiving floating on a notional $10 million. In year one, the floating rate turns out to be 4.2%, and in year two, it's 5.8. Compute the net payment each year. So the company pays on fixed. In the first year, the floating rate is less than fixed, so fixed is greater, and we can compute the net payment. It's just the 0.05 minus the 0.042 times 10 million, and we get 80,000. So the company pays 80,000 since the fixed rate exceeds floating. However, in the second year, the floating rate exceeds fixed, so we do the calculation, we get negative this time. And since we've kind of balanced these exactly, it's negative 80,000. The negative sign means the company receives $80,000. Okay, then I have a comment here not specific to the example. Other common swap types include currency swaps in which parties exchange cash flows in different currencies. So here you're not exchanging interest, but also the actual cash flows. And commodity swaps in which one party pays a fixed commodity price while the other pays a floating market price. The general idea is the same. Two parties exchange cash flows in order to transform one type of financial exposure into another. On this slide and the remainder of the lesson, I'm going to talk about structured credit products. The instruments discussed previously in this lesson and the previous options, futures, swaps are straightforward in structure, even if their pricing could be mathematically involved. A second family of derivatives known as structured credit products bundles together existing debt obligations and repackages their cash flows. These products became central to the 2008 financial crisis, which I'll talk more about as we proceed. So the first one I want to look at are called, the first one out of these structured products are mortgage-backed securities, or MBS. Uh, they're created by pulling together a large number of individual mortgage loans, maybe thousands of home loans from different borrowers, and sells claims on the combined cash flows to investors. The investors receive the monthly principal and interest payments made by the underlying borrowers, netting a service fee that the entity that bundles them together gets. The MBS transforms illiquid individual mortgages into tradable securities. The appeal to investors is diversification. Even if a few borrowers default, the pool as a whole continues to generate cash flow. So here's the advantage, but it's also the disadvantage. If, in fact, the reason that the borrowers default is widespread, and then you no longer have diversification, you have a collapse, which is part of what happened in the 2008 financial crisis. But on the surface, that's the idea, that you get diversification. You're not just taking on one person or a few person's loan. You're taking on a very large number of loans, possibly from different parts of the country, maybe even different countries. The appeal to the originating institution is that it can remove the loans from its balance sheet, so they were holding these loans, and receive cash immediately, which it can use to make new loans. This process is called securitization. The mathematics of MBS pricing is an extension of the loan amortization framework. The cash flows from the pool are essentially a large annuity, subject to uncertainty because borrowers may prepay their mortgages, in other words, pay them early, or refinance, or default. Prepayment models and default probabilities must be incorporated to compute a fair price, making MBS valuation considerably more complex than a standard bond. So we're not going to get into that here, but I just wanted to mention some of the main facets of these MBSs. Okay, so let's continue. There's more or different types of these structured credit products. The next instrument I want to talk about are called collateralized debt obligations, or CDOs. This takes structured products one step further. Instead of pooling individual loans, a financial institution creates a CDO trust that pools a collection of debt securities, which may themselves include mortgage-backed securities. Rather than selling this entire pool as a single investment, the trust divides the cash flows into what are called tranches or slices. Investors, let me point to where I'm at. Investors do not buy CDO as a whole. They choose to invest in a specific tranche based on their risk. So I have an example here where you have three tranches and all based on some underlying collection of securities. And the senior tranche is paid first. The trust pays investors their promised return before any lower tier tranches receive money. They absorb losses only after junior tranches, these two which I'll mention, are wiped out. So these are typically AAA ratings, so the highest rating, and by the way, the lowest return. So as you go from senior to downwards, in terms of these tranches, the risk is higher, but the payoff is also higher. So you have this mezzanine tranche. They're paid second. Once the senior investors are fully compensated, the trust pays this layer. They absorb intermediate losses and typically hold a BBB rating or similar. And then you have the equity tranche paid last. These investors receive whatever cash remains at the bottom of the waterfall being these tranches. They absorb the first losses if underlying borrowers default. Because they take on the highest risk, this unrated or below investment grade layer offers the highest potential return. The tranching process can make highly rated securities from a pool of riskier underlying assets. The senior tranche of a CDO backed by BBB-rated mortgages might itself receive a AAA rating because the probability that losses are large enough to reach the senior tranche is estimated to be very low, provided the underlying assets are sufficiently diversified and the default probabilities are correctly modeled. Okay, this doesn't always happen. So in the years before 2008, CDOs were frequently built from pools of subprime mortgage-backed securities. Rating agencies assigned AAA ratings to senior tranches based on models that underestimated the degree to which mortgage defaults would be correlated. When house prices fell nationwide, talking about the United States, although it had happened in other countries, defaults surged everywhere at once rather than being scattered independently across borrowers. The diversification benefits largely disappeared precisely when it was most needed. So in a nutshell, that was the cause of this 2008 crisis. On this slide, I want to talk about another type of structured credit product known as a credit default swap, or CDS. Despite its name, it's not a swap in the sense discussed earlier. It's more precisely described as a form of insurance against the default of a particular borrower or debt instrument, which is known as the reference entity. In a CDS contract, the protection buyer buys a periodic fee, the CDS spread or premium expressed in basis points per year on a notional amount. A basis point equals 1/100th of a percentage point, making it a precise way to discuss even very small rate movements. The protection seller receives this premium, and if a defined credit event, such as a default, bankruptcy, or failure to pay occurs, the protection seller must compensate the buyer for the loss on the reference obligation. So I have an example of that here. A bank is holding $10 million of corporate bonds, might buy CDS protection at a spread of 150 basis points, 1.5% per year. The annual premium is this 0.15 times 0.015, times 10 million or 150,000. If the company, and it's referring to the company that issued the corporate bonds that are being held by the bank, if that company defaults, the bonds typically don't go to zero. Suppose the bankrupt company has enough assets, again, this is the company that issued the bonds, to repay 40 cents on the dollar to the bondholders, in this case, the bank. This means the bank suffers a loss of 60% or 60 cents on the dollar. The CDS contract is designed to make the bank whole by covering the exact shortfall. So the protection seller pays the bank 10 million times the 0.6, the loss, or $6 million. Now, of course, if that doesn't happen, the seller of the CDS keeps the 100. Well, they keep the 150 either way, but if nothing bad happens, that's 150,000 profit. So given the potential here of having to pay out that much, you would assume in this particular case the probability of default is fairly low, and the bank is just being very cautious by sharing some of the profits with this CDS protection company, just in in the event. And there may be laws that require them to do things like this. I don't know, but I could imagine that might be a law requiring this. CDS contracts can also be used for speculation. An investor who believes a company is likely to default can buy CDS protection without owning any bonds, effectively betting on the default. This use of CDS as a speculative instrument rather than a hedging one was widespread in the pre-2008 period and significantly amplified the financial system's exposure to the housing market. On this slide and the next, I want to talk a little bit more about the 2008 financial crisis. We already defined some of the main components, so let's look a little deeper. By 2007, the three instruments just described, and I put the acronyms up here just to jog your memory. So we had the MBSs, mortgage-backed securities, collateralized debt obligations, CDOs, and then the credit default swap, CDS. So they had become very intertwined by this year before the crisis. Mortgage originators issued loans to subprime borrowers. Those loans were securitized into MBSs. The MBSs were pulled into CDOs, which were sometimes pulled into CDO squared structures. CDSs were written on all of these securities, creating webs of insurance obligations whose full extent was unknown to any single participant. Three systemic features made this accumulation of risk fragile. I'll talk about these on this slide and the next. So the first one was opacity. Each step in the chain, from individual mortgage to MBS to CDOs of CDOs, made it harder to assess what was actually inside the security. Buyers of CDO tranches and even the credit rating agencies assigning grades to them often cannot verify the quality of the underlying mortgages. This informational opacity meant that risk was systematically mispriced across the entire market. Then we have the second item, leverage. Many participants funded their holdings of these securities with borrowed money, amplifying both gains and losses. An institution that borrows 90% of the cost of an asset, leverage ratio 10 to 1, earns 10 times the return if the asset rises, but also suffers 10 times the loss if the asset falls. When the housing bubble peaked in 2008 and house prices simply stopped rising, many subprime borrowers could no longer refinance their loans, triggering a wave of initial defaults. Because of the immense leverage in the system, these localized defaults translated into catastrophic losses for the holders of subprime, MBS, S's, and CDOs. Okay, the third item causing the issues in 2008 was interconnectedness. Because CDSs had been written on essentially all of the relevant securities, the failure of one institution could immediately trigger losses at the CDS counterparties, which might in turn be unable to meet their own obligations. The insolvency of a single firm like AIG, that's an insurance company, which had sold enormous quantities of CDS protection, threatened to cascade through the financial system in a way that no individual actor had anticipated or had the information to foresee. Ultimately, this structure transformed localized mortgage defaults into a global financial meltdown. When a relatively small cluster of subprime borrowers defaulted on their home loans, the extreme leverage in the system caused the value of the associated mortgage-backed securities and CDOs to plummet. This collapse triggered the credit default swaps written on those securities, legally obligating insurers to pay out billions of dollars simultaneously. Because these institutions lacked the cash to cover such a massive synchronized payout, they faced immediate bankruptcy. This threatened the solvency of the global banks relying on those insurance contracts, turning what would have been a contained real estate correction into a worldwide chain reaction. The lesson is not that derivatives are inherently dangerous. Options, futures, and plain vanilla swaps perform valuable economic functions and continue to be traded in enormous volumes. The lesson is that complexity, opacity, and leverage, when combined with inadequate understanding of how correlation behaves under stress, can transform individually comprehensive instruments into a collectively incomprehensible system, which is what happened in 2008. Okay, so that was the last bit of information in this lecture, other than the next slide where I summarized some of the formulas that we talked about. So let's have a look at the last slide. Okay, so I have some of the instruments we talked about and a very brief description, and then some of the formulas. We didn't get into the details of the structured credit products. We just mentioned some characteristics. So you may want to do a screen capture of this if you want to save it. This is also a table in my book in section 9, actually at the very end of section 9. I'll make the electronic version of the book available free. And if you're interested in a paper copy, I'll give you a link to that. You can buy that on Amazon. And just one other thing, chapter 9 of my book also has some exercises, which I'm not going to go through here in my lesson, but you may want to look at those. And then there's one final chapter in my book, which I'm not going to do a lesson on, and that's sort of a complete life cycle for a couple who gets married, buys a house, pays for their children's college education, and then saves for retirement. And that ties together not everything, but a lot of the concepts in my book. So you may want to download the electronic version just to look at that example, which I think is quite instructive. Okay, so that's the last in this series of videos. I do plan to have some other videos on other topics, but in terms of financial math, at least for the time being, this is the last video I had planned doing. So if you like them, please give the videos a thumbs up and subscribe to my channel.